Well, we welcome the Valentine's week to a consumer price index that came in above estimates, but lower than last month. So 3.4% inflation was the previous month's reading. January of this year comes in at 3.1%. Not as low as many had hoped. That is the headline inflation. Beneath projected a 3 to 2.9% headline inflation number. Did not get that. And the core inflation, which is really the heart of what the Fed is looking for in their rate making decision, came in steady at 3.9% for the second month in a row. So no change. A lot of projections were for a little bit lower at core inflation. Really more kicking the can down the road. We've said previously that it could be middle of the year before the Fed sees the signs that they can start to cut rates. This is going to be one of those signs, I'm afraid. So we'll take a look at the charts. As you can imagine, interest rates are moving up as a result of the above expectation inflation numbers. So the U.S. 10-year is up 10 basis points this morning at 4.27. The stock market's down as a result. Like I said, above expectation on the inflation numbers. Really cuts to zero the chances of the next Fed meeting in March being a rate cut. So more likely at their next couple of meetings, they could have an opportunity in May and then another one probably in June before we're going to see enough data to that is, if inflation comes down, enough data for the Fed to start to cut rates. So as a result, mortgage-backed securities are higher. So the prices are down, meaning the interest rates are up. You can see that on the 10-year, well above the 200-day average. We kind of fought that this last week. A good inflation number could have brought us back down in line with the trend. Instead, we're breaking the trend and basically looks like interest rates up to a level that we hit last back on December 11th. So we're taking a few steps back before we can take a step forward on the inflation data. Just see mortgage-backed security charts with 38 basis point reduction on the price there. That's very similar. We're taking ourselves back to levels that we hadn't seen since early December. So we're taking a couple months back and we'll see how this plays out over the coming next group of inflation points, which would be wholesale inflation later this week, as well as the PCE, which is the personal consumption expenditure later in the month. That's actually the Fed's favored measure of inflation, and they'll get that before their next meeting coming in March. So don't hold your breath quite yet for lower interest rates. We are trending in the wrong direction, but we will keep an eye on that and come out in the coming months as we get into the spring selling season. As activity starts to pick up, can we unlock a little bit of inventory with slightly lower interest rates, or will people just finally get used to 6.5 to 7% handle on their mortgage rate? We shall see. Have yourself a great week.